Thank you, Professor D.N. Reddy, Professor Ramanamurthy, Professor Surijit Majumdar, Professor Patnaik, Professor Upadhyay, uh, distinguished delegates, students, and faculty. It's, of course, for me a privilege to being invited to be a part, even if virtually, of this 25th annual conference of the Political Economy Association. And of course, it's a privilege to be part of such a distinguished panel. Um, Professor Patnaik, of course, has laid out the big picture, almost a grand theory understanding of the sort of structural and deep contradictions which have characterized capitalism. Um, well, since the Second World War, but particularly after the late 1960s, when the golden age came to an end, and it became difficult for uh, the leading nations of the world, the metropolitan centers of global capitalism, to be able to sustain the high rates of growth, the low unemployment, and low inflation, which was a combination which was almost unprecedented for such a long period of time in the history of capitalism. But that couldn't be sustained anymore, and he had, put out this picture of the factors which subsequently have resulted in this new normal, where despite efforts to generate bubbles, you are not in a position to be able to raise the rate of growth to levels that capitalism had managed to achieve in the years after the Second World War. Now, I just would add a footnote to this, focusing on what is uh, uh, a parallel, though intrinsic tendency towards this process of accumulation, which or to this regime of accumulation which he specified. And this is to actually try and look at the kind of impasse which states in the metropolitan countries have reached in terms of their ability to be able to sustain even a minimal rate of growth, besides, of course, preventing periodic crisis. After all, the golden age was a period in which it was argued that capitalism finally had found its way out of cycles, that we're not going to have a repeat of anything like the Great Depression or even of significant recessions, because of the fact that the state was in a position to be able to intervene. And of course, at that point of time, intervene in terms of using the fiscal lever in order to prevent that, such that it was argued by many advocates of the sort of benefits of capitalism or the success of capitalism, that we had reached a stage in which recessions or cycles were a thing of the past. And we know that not only was that not true, but more importantly, we know that the 2008 crisis was almost a crisis of the dimensions that the Great Depression was. Now, if we look at the kind of intervention which the state has been undertaking in the period, let us say, since the late 1980s, once we had deregulation, liberalization, removal of all shackles on the functioning of finance, both domestically in the metropolitan countries and globally, because of the influence which these countries could assert on developing countries, which were forced into dropping what was described as financial repression and going in for financial liberalization. We know that that what really happened was we entered a phase in which there has been, besides the sort of new normal of relatively slower growth, there has been this tendency for this sharp deviation in the performance of the real economy and the financial sector. By financial sector, or I should say, all asset markets, real estate markets, bond markets, equity markets, and so on, where despite periodic crisis, they always seem to be in a position to be able to pick themselves up and move on. In fact, even after the Great Recession, despite the long period it took even to sort of prevent any further dip in economic activity in the developed countries and therefore elsewhere in the world, you actually had a situation where we saw one of the longest booms in the New York Stock Exchange, in at least in the history of capitalism. Now, so what really explains this this tendency, one, of this sharp deviation between what happens in the real economy, the reasons for which were discussed by Professor Patnaik, and what happens in the financial or asset market realm. What are the implications of that for where capitalism is today? And what really does that imply to a certain extent for developing countries, particularly for the so-called emerging markets like India? And that's what I'd briefly like to touch upon. Now, if we go back to as early as 1987, when Alan Greenspan took over from Paul Volcker after a banking crisis. He was very clear that he said that, listen, the role of the Federal Reserve is now going to be to ensure that there is adequate liquidity in the system to facilitate the normal, by normal, uh, he was arguing a situation in which large financial profits can be made, that it's going to facilitate the functioning of financial markets. That's the way he specified the new role of the Fed once Paul Volcker fought inflation and brought it under control, but of course simultaneously triggered a significant economic recession in the United States and in the other developed industrial countries, OECD countries. Now, since then, what we've really had is a situation where, partly because of the fact that the United States is of course home to the reserve currency, but not only because of that, what we've had is, along with the inability of capitalist states, or not inability, the unwillingness of capitalist states to use the fiscal lever anymore to fight recessions or to fight crises of the kind that was pointed out by Professor Patnaik, what we saw was an increasing privileging of the monetary lever. The argument was that, listen, basically now macroeconomic management must move from the fiscal realm to the monetary realm. The first task, of course, is going to be targeting inflation, to keeping inflation low. And once inflation is low, the role of monetary policy or monetary levers should essentially be that of trying to facilitate dynamism in capitalism. And that was the argument which was given for privileging over a period of time monetary policy over fiscal policy. But fiscal policy was something which no more could be exercised the way it was exercised earlier, partly because of the globalization of finance and partly because of the fact that finance, as Professor Patnaik pointed out, finds any fiscal deficit to be anathema. Now, it turned out, of course, that that was a period, given the fact that finally victory was won over primary commodity producers, in particular oil, after the oil shocks had pushed up oil prices so much. And the relocation of manufacturing to low-wage countries with large reserve armies of labor, particularly to countries like China, resulted in a situation where, on average, the world was going through what's described as the Great Moderation. There was no significant inflation. Inflation was under control because prices were under control, because wages and commodity prices were under control, because of the fact that after the crisis, the conquest over labor, both in the less developed countries and in the metropolitan centers and of commodity producers, helped ensure this great moderation. Now, if you have a great moderation of that kind in a context in which finance is pushing for the monetary levers or monetary policy to be the principal instruments you're going to use to macro manage capitalism, then your primary concern is not fighting inflation anymore. Your primary concern, because inflation is under control, your primary concern becomes ostensibly to use these monetary levers in order to be able to ensure a certain degree of dynamism of capitalism, or at least that was what the argument was. Now, what form did this take? The form this took was to ensure that there was a significant volume of cheap liquidity which was available in the system, which was expected to finance a credit boom, which pushes consumption, consumption demand for automobiles, demand for housing, etc. Plus, of course, actually results in a situation where there is a significant increase in corporate borrowing, which will sustain investment. The whole idea was that low interest rates and large liquidity would allow for a significant increase in both investment and consumption and lift the global capitalist economy. Now, what we observed in practice, of course, was two things. First, of course, to the extent that you did have this credit boom, and we know we had that credit boom in the years after 2001, after the fall of the Twin Towers, when it was decided that the way we're going to respond to this new situation, which people feared is going to result in a crisis of capitalism, which came because of this political or geopolitical event, which sort of hit at the heart of capitalism in some sense. The whole idea was you're going to inject huge volumes of liquidity into the system, and you're going to do it at extremely low interest rates. And that did, to a certain extent, for a short period of time, till the 2008 global financial crisis, push growth financed on the basis of a credit bubble. The second thing, of course, which happened was that this large volume of liquidity, which was being pushed into the system, resulted in asset price inflation, real estate asset prices, bond market prices, prices in equity markets, in stock exchanges. All these indices began to rise. And at that point of time, even conservative publications like, for example, the Financial Times and the Economist and so on, said that, listen, we should be careful because this is an asset market bubble, that this is unsustainable, where you're having this kind of a so-called boom in these asset markets. At which, of course, Greenspan, who was still there till 2007, he of course generated the conditions for the 2008 crisis, and then had the good fortune to be able to go home and without having to manage that in full. That he basically said that, listen, no, there's no problem. There's no inflation, by which he meant no inflation of goods and services prices. And of course, if there is some increase in prices in asset markets, that's not a bubble. That's not a bubble. There might be some froth out there, but there's no real bubble. Now, we know what that did was it actually generated a situation where finally this asset market bubble, starting from, of course, the housing market, but that wasn't just a housing market collapse, but a collapse of the financial system, resulted in a financial collapse because it was unsustainable. It was a bubble which was being driven by this infusion of large volumes of cheap liquidity into the system, which of course justified itself because of the fact that for a short period of time, it could give you real economic growth financed by the credit bubble, which went to push demand and an output in the automobile market, in the consumer goods market, in the housing market, and of course, to a certain extent, in terms of corporate investment, to the extent that corporate investment was occurring in the metropolitan centers as opposed to the regions to which manufacturing was being relocated. Now, the interesting thing is, once the 2008 crisis happened and we entered the Great Recession, the expectation was, particularly when Obama came and so on, the expectation was that capitalism has now learned its lesson. It's going to go back to the kind of lessons it learned after the Great Depression. There's going to be a restoration of a certain degree of importance for fiscal policy. And therefore, this situation where in macroeconomic management, you privilege monetary policy over fiscal policy, resulting in this kind of a fragile environment where there's a high degree of instability and vulnerability of capitalism as a system, heightened because we know that capitalism is always an unstable system, that it was expected that this transition would occur. There would be a restoration to a certain extent of a certain importance for fiscal policy, but that didn't happen. And what we actually saw was that the response to the 2008 crisis was really an effort to try and push further the use of monetary levers, of injecting through what is called quantitative easing or large-scale bond buying by the central banks of the developed industrial countries, developed capitalist countries, and of course interest rates which were zero or near zero, and in some cases even negative. You actually were trying to push that kind of, once again, push that kind of thing, so much so that the balance sheet of the Federal Reserve, which was about 800 billion US dollars at the time of the 2008 crisis, by the time you got to about 2012, in a very short period of time, had reached more than 4 trillion. So there was this huge infusion of cheap liquidity, which of course we know now didn't actually address the real economy problems generated by the global financial crisis in the form of the Great Recession. What it did was, while you actually had the continuation of the new normal of slow growth, you saw a large part of this spilling over, one, into asset markets in the developed industrial countries, generating another asset market boom. And two, it actually spilled over into the world economy, a large part of it flowing into developing countries. In fact, even some poor developing countries, which now began to see the emergence of bond markets, but definitely to emerging markets like India, so that we know that in the period, after the early 2000s, we saw that the Indian, other than for sort of particular years like 2008-9, India became a favored destination, as many other emerging markets became, for the flow of financial capital. Now, as this process continued, and it was becoming clear that, listen, we're not getting a proper significant recovery from the Great Recession, but we are getting this huge asset market inflation or asset market bubble, or as some call it, an asset market boom, that this obviously was resulting in recall of the possibilities of what could happen, of the kind that happened in 2008, so that many sort of more conservative institutions like the Bank of International Settlements, etc., began to say that, listen, we cannot continue with these unconventional monetary policies, this near zero interest rates or zero interest rates and huge infusion of liquidity. This has to be reversed. So the challenge became not really of trying to say that how could we restore the importance of fiscal policy, but the challenge became how could we unwind these positions which central banks have taken, buying up at the time of the crisis, of course, even worthless assets, not just from the commercial banks, but from the open market, as part of quantitative easing. That how are we going to unwind this without getting ourselves a hard landing? Because when you begin to unwind this, when you push up interest rates, when you stop the process of quantitative easing, you're not going to be able to find the kind of liquidity which sustains this boom, because that had to be constantly fed. And you're going to have a situation where there's going to be problems in financial markets. And we know that when financial markets begin to unwind, externalities are many, and those externalities are also externalities which affect the real economy and affect those in particular who have hardly anything to do with these financial markets, which are generating these huge profits and bonuses for a small elite who constitute part of the 0.1% of the population, or whatever it may be. Now, this impasse where you're basically saying that, listen, okay, I because of the power of finance, I'm not going to go back to fiscal policy, but I have to unwind what I thought was the mechanism I can use, because that is actually generating a set of effects which are problematic. That impasse was something which pointed to the fact that no more was the state under contemporary capitalism in the metropolitan centers in a position to be able to say that, listen, don't worry, we still have our solutions to be able to manage this extremely volatile capitalism which we have created as a result of neoliberalism or deregulation and liberalization of the kind that had gone on for decades. Now, interestingly, this was reversed, as Professor Patnaik said, very briefly during the period of the pandemic in the developed industrial countries, because of the fact that during the pandemic, you actually found the need, since there was this complete sort of stop to economic activity, a sudden stop to economic activity, you found the need to be able to provide some degree, to undertake some degree of spending, not merely to address the pandemic, but to address its fallout, to address the lockdowns, to make some cash transfers to those heavily affected, to try and save small businesses and big businesses, and so on and so forth. So we did see in the developed industrial countries some increase. In some countries, 20% or more of GDP was the fiscal, was the fiscal stimulus which was provided, resulting in some increase in the fiscal deficit, which of course is leading to the great divide, which Professor Patnaik pointed out. But also, simultaneously, you actually decided that in order to save finance and to a certain extent to save, capital in general, you decided to pump even more cheap liquidity. The agenda of withdrawing or unwinding the unconventional monetary policies was dropped. And you actually saw that from some 4+ trillion, the balance sheet, for example, of the Federal Reserve went up to something like 12 trillion. in a period of a couple of years. And that was just the Federal Reserve. Similar tendencies were visible in the European Central Bank, in the Bank of Japan, and etc., the Bank of England, and so on. So you actually had, while there seemed to be a brief period of a return to fiscal policy in the metropolitan centers, you actually still had the same basic privileging of monetary policy over fiscal policy because of the power that finance exerted over the system. And once the pandemic was over, you ended up with a situation in which fiscal policy began to now be it once again sort of dampened or kept under control, because you said borrowing by governments has gone too far, the fiscal deficit is too high, etc. And the current president of the United States begins to face problems. Senior moment, begins to face problems of trying to pass his bills in which he wanted to have large spending undertaken. Now, the consequence of this, and that's what the consequence of this has been, that in some sense you not only had the continuation of that bubble in financial markets, which had occurred during the period after 2008, but you actually had a situation in which you had this huge, build up, even further build up of investment in all of these speculative assets, which was the basis for which there was basis on which financial profits increased hugely. Now, therefore, you entered a period when, after the pandemic, partly because of the problems which the pandemic created in terms of supply shortfalls, and of course it also affected demand, and partly because of what it did to supply chains, to transportation, and so on and so forth, you began to see a tendency towards inflation, which of course pushes these states to increasingly hold back on fiscal policy. But more importantly, what it began to do was to say that, listen, we have to address inflation. And if you have to address inflation, because you're now talking about inflation rates of 7-8% in the United States, consumer price inflation, so you basically then decide that you have to unwind. So now the Federal Reserve has said that it's, in a single year, it's going to push up interest rates by 3%, policy rates by 3%. In country after country in the metropolitan centers, quantitative easing or the bond buying strategy is being withdrawn. And this is actually beginning to have an impact on financial markets. And it's beginning to have a serious impact on emerging markets like India, where there's a significant outflow, because we opened our borders for cross-border flows of financial capital in the hope that that's going to do something to growth. It really is not something which comes into the secondary market. It really doesn't push investment very much. But in moments like this, when you're seeing huge outflows, we know what it's doing to the rupee. We know the uncertainties it is creating. And therefore, we are caught in a situation now where capitalism cannot go back to fiscal policy to a certain extent because inflation is on the rise. It cannot continue with these unconventional monetary policies because the great moderation has come to an end. And it is now seeing an intensification of the crisis because of the effects of the pandemic, on top of the unresolved Great Recession, and finally, of course, the outbreak of the war or the invasion in Ukraine, which is resulting in a situation where inflation gets aggravated, and you have a situation in which, in multiple markets, you actually beginning to face shortfalls in supply, increases besides increases in prices, which is going to affect growth. So there is an impasse. We seem to be in a position today where, as was said by Professor Patnaik, even if the war at some, within hopefully a very reasonable period of time comes to an end, even if the pandemic wanes, you seem to be caught in a situation where you cannot actually, you still, subordinate fiscal policy, but you cannot exercise, use the monetary lever. And that's going to create a situation where it's going to become difficult to resolve this crisis as quickly as perhaps they thought that they'd resolve the 2008 crisis. But more importantly, for emerging markets like India, and also for developing countries which borrowed heavily and now suddenly find oil prices going up, you're going to see a huge crisis. A country like Sri Lanka, for example, is experiencing it in multiple ways. And therefore, that great divide, which was spoken of, is going to be even more intensified. Thank you.